Hey guys, Toby Mathis here, and today we're going to dive into 4 real estate hacks that can literally eliminate all your taxes on all your other income. Now, there used to be an old adage in the tax world that if you paid real estate or if you paid income taxes, it's because you didn't own enough real estate. They'd always say things like, oh, you're paying taxes, buy some more real estate. And it doesn't quite work that way, right? A lot of us realize pretty quickly that the IRS treats real estate differently. That's a passive activity, and there's the passive activity loss rules. Now, prior to 1986, different world. You could use those as tax shelters and wipe out your income, but they changed that. But when they change things, they always open up windows all over the place that you could jump through and still get to the same place if you know what the rules are and if you know how to use those rules to your benefit. So today I'm going to go over 4 of those rules, and I'm going to call them 4 real estate hacks. So here we go. Number 1, and a lot of you guys have heard about this before, it's this real estate professional status, and it's the Holy Grail of tax deductions when it comes to real estate. And here's what it is. Generally speaking, if I have real estate investments, so rental properties, and it doesn't matter whether it's residential or commercial, those losses that I create on that property through the use of cost segregation or bonus depreciation or just standard depreciation, if it creates losses, I don't get to use those losses against my wages or other types of income, even my capital gains. If I don't want it to be treated as passive, then I have to qualify as something called a real estate professional. Now, there are 2 prongs to real estate professional status. Prong number 1 is you are in a real estate trade or business and you spend more than 750 hours per year in your real estate trade or businesses. It could be 1 or more, but you have to spend more than 750 hours cumulatively. You have to materially participate in those businesses, which if you're spending that much time, you're obviously going to qualify, but it's a real estate trade or business in which you materially participate. And number 2, it has to be more than 50% of your personal use time, like your personal, your time for money, right? So your personal services. So if I am a realtor, for example, realtor activity would qualify as a real estate trade or business, as would anything in development, construction, brokering, managing real estate. They all qualify. If I materially participate in that, which means I spend more than 100 hours a year, really that's the litmus test. The higher litmus test is 500 hours. But if that's my profession and I exceed 750 hours and it's more than 50% of my personal service time, then I would meet those first 2 prongs and I would be considered a real estate pro. That's just, and one spouse, if you're married, has to meet that test, the 750 hour greater than 50%. So if I'm a realtor, even if I don't buy and sell my own real estate, it's just for other people. So long as I own my brokerage or am a 5% or greater owner in my company, even if I'm an employee, I get to count that time. And let's just say that I'm a full-time real estate agent. I'm going to meet the 750 hour test easy. And if it's all I do, great, I qualify. Real estate pro, prong 1. Prong 2, I materially participate on my rental activity. And this is what trips people up. Now, this is different tests. There's actually 7 different rules. I'm just going to break it down and make it real simple for you, though. Number 1, this is per property unless you elect to aggregate all your rentals as one activity. So the first thing you have to do is say, shoot, I need to treat all my rentals as one activity. You want to do this under the advice of an accountant in case you have some suspended losses and things. You want to make sure you lose them as you go forward. But for the most part, you're going to make an aggregation election. And then you just have to materially participate on those, which means as a couple, if you're spouses, you add up to more than 100 hours and nobody else does more than 100 hours, or you did 500 hours, in which case we don't care about what anybody else did, or you did all the activities. You self-managed. Nobody else did substantial activities on the property, so you did everything on the properties. You meet those. Even if you only have 2 properties in your state and you got 20 all around the country, as long as you meet that test, you can apply them all and treat them all as one big property. So if I meet the material participation test and I'm a real estate pro, boom, my losses are no longer passive and they can offset my income. I make $100,000 a year in my job and I have $100,000 a year in losses from my real estate. I pay zero tax. Yay. Well, I'd have employment taxes still, but I wouldn't have any income tax. And that's assuming your state will also apply the same thing. Bonus depreciation, accelerated depreciation, not all states will recognize it. So it's the joy of doing calculations, but Real Estate Pro is what really unlocks those losses. Now, you still have a limitation on how much loss you could take every year. Talk to your accountant. I'm not going to dive that deep. But you can wipe out, $200,000, $300,000, $400,000, $500,000 of income by using Real Estate Pro status. Number two, a little bit easier test is active participation. What is active participation? I decide who gets to stay in the place. I review leases. I manage the manager. If I am an active participant, I can write off up to $25,000 a year of passive losses against my other income. So let's say I make wages of $100,000 and I have real estate losses of 20. I could use the entire $20,000 of real estate loss to offset my $100,000 of wages if I am an active participant. It's not too hard. Now, here's the reason most people don't qualify. Because it phases out. Between $100,000 and $150,000, for every $2 it goes up, you lose $1 of the $25,000. So if it goes between $100,000 and $150,000, that's $25,000 that just got phased out, which means you get zero deduction once you get over $150,000. If you are at $120,000, then you're going to lose $10,000 of the deduction. You'd be able to write off up to $15,000. Because again, it's for every $2 above 100, you lose $1. So if you're at 25,000 and there's 20,000, for every $2 you lose $1, it's $10,000 that you lose. So 25 minus 10 is 15,000. That's the maximum amount of deduction you would get as an active participant if you were making $120,000 a year. All right, so that's active participation, but it does help you eliminate your tax. It's not going to get you to zero unless you have other methods and other means that you're using, maybe some of these other strategies, and you get your taxes down to $20,000 and you have $20,000 of loss, then you'd get down to zero. Right? We can get there, but it's up to generally $25,000. Number three, this is fun. Loss carry forwards. And here's why it's important. When you get rid of a property that has massive loss carry forwards, let's say that you've had a property for 10 years and it had a bunch of losses on it, and you're just like, I've never gotten to use all those passive losses because I'm not a real estate professional and I never got to use active participant. So all it did is it carried forward. When you sell that property, the carry forward releases, is used against the gain on the property, and then is non-passive loss there, and it can offset your other income. So if you have large loss carry forwards on properties, you may want to explore whether getting rid of that property could result in substantial tax savings to you, because it might be a factor in deciding whether you get rid of something now or whether you hold it for the long term, especially a property that's not producing income the way that you anticipated, or that's had more repair expense or carrying costs than you anticipated, and you just don't like it anymore. And you just say, you know what, I want to get rid of it. There might be a situation where you look at those loss carry forwards when they get released, and they're your friend. The other way you use loss carry forwards is if my income is being derived from real estate, even if I'm passive. If my income is passive, businesses that I do not materially participate in or rental properties are passive activities. I could use my passive loss carry forwards in their entirety to wipe out any of that income. So if I am living off of my rental properties and I'm making $50,000 a year, of taxable income, not income. Like let's say I'm making 100, but I'm only having to pay a certain amount. I have depreciation and all these other things, but I only have $50,000 of taxable income. Boom, my loss carry forward might wipe that out. I should know that. I should be looking at that. I should be calculating that as I'm going forward and working with my tax planner, because they might say, hey, work smarter, not harder. Don't do this type of job. Do this. This is when you make money over here. You're using these loss carry forwards, and some people have substantial loss carry forwards. You know, the big ones that I see tend to be capital loss carry forwards, which is going to help us in this setting. But I've seen a lot of people over the years who never got to use their passive losses, and they're just carrying forward, carried forward, carried forward. You may want to start looking at strategies saying, hey, I don't have to pay tax on this type of income. Maybe I'm going to deliberately start making more passive types of income. And then number 4, this is the short-term rental loophole. And why is that? So let's go over what it is. Short-term rental means 7 days or less, or if it's greater than 7 days, that there's significant services involved or extraordinary services involved. But just for our purposes, to not get too deep, we're just going to say 7 days or less. So Airbnb averages less than 3 days per stay, right? Let's just say anything 7 days or below is not a rental activity. You're actually a hotel. And a hotel is a trade or business. So it's not an investment activity anymore. Now you are a trade or business. And so when we start talking about short-term rentals, what we are saying is you are no longer a real estate investor. You are actually running a business. And if you're running a business and creating losses, so long as you materially participate in that business, and there's 7 tests for material participation, right? You do substantially all the activities. So you run your own short-term rental. You and a spouse spend at least 100 hours a year, and nobody spends more than 100 hours, more time than you on that property. So you could be spending, let's say you had 3 short-term rentals, and you're spending between you and a spouse 120 hours a year, nobody else. And we're talking about individuals. So even if you have a company that's a management company, so long as none of their employees or their representatives are spending more time than you and your spouse added up, then you're fine. That would work. Or you and your spouse are spending more than 500 hours a year. Those are the most common. There's other tests, but those are the most common where we're starting out on. So it's you're doing everything, or you're 100 hours or more, or if 500 hours, we don't have to care about anybody else. Document those hours. Then the losses from the short-term rentals are non-passive, and you can use them to offset your W-2, your wages, your capital gains. You could use it to offset any other type of income. So that short-term rental loophole becomes your friend, especially for my high-income clients, doctors, etc. They're looking at it going, if I could buy a valuable short-term rental every year in a place that I would like to visit, like I want to own houses in places that I want to go, and they start buying kind of higher end, and they're willing to operate it themselves for, let's just say that every fall we buy a house, and we're just going to own it for a few months where we run everything. If you're willing to do that, the tax benefits could be extraordinary, because you could materially participate, you could be the one that qualifies, and then you could do what's called a bonus depreciation and cost segregation on that property, accelerate a ton of that depreciation, usually about 30% of the improvement value of a property, up to about 40%, and I can make a massive deduction that I can use to offset my income from being a doctor, right, or a high income person. It can literally be at the 50% marker if you're in New York or California, and these things can make an extraordinary impact on it. So if you are willing to use that short-term rental loophole, you're willing to go in there and materially participate on your Airbnb, the payoff can be extraordinary to you from a tax standpoint. So those are the 4 real estate hacks that can keep you from paying tax on your income. Please smash that like and subscribe button. If you have any comments, leave them below. And if you know anybody that could benefit from this information, please share it.